Chancellor of the Exchequer, the Right Honourable George Osbourne, Member of Parliament.
Over the cheese, Mr Osborne set out how Labour's tripartite banking system had gone mouldy.
The Bank of England was mandated to focus on consumer price inflation to the exclusion of other things. The Treasury saw its financial policy division drift into a backwater. The FSA became a narrow regulator, almost entirely focused on rules-based regulation. No one was controlling levels of debt, and when the crunch came, no one knew who was in charge.
Now, one man will be in charge.
Raise silence for the Governor of the Bank of England, Mr Mervyn King.
The Bank of England's boss gets to swallow up the duties of the old regulator, the FSA. Mervyn King will take control of so-called macroprudential regulation, in plain English, stopping the banks from crashing the economy. And he'll also get to oversee so-called prudential regulation, keeping the individual banks on the straight and narrow. The Shadow Chancellor, demure at the dinner table, had already got his retaliation in, pre-cooked.
Far from abolishing the Financial Services Authority, the chief regulator as the Tories proposed before the election, they appear to be emasculating it, with some decisions being taken by the Bank of England, some decisions being taken by the FSA, and that seems to me a complete dog's breakfast of a system.
But Britain's banks are faced with even bigger questions than who regulates them. With the industry still groaning under a surfeit of bad debt, Mr Osborne listed them.
Should we restrict or split the activities of the banks? Has our banking industry become too concentrated and uncompetitive? Now, I know there are those who are frustrated that these questions are even asked. But how can they not be when so many millions of people are paying the price for what went wrong?
But he didn't answer the questions. Instead, he set up a commission that will take a year to mull them over. It's headed by economist Sir John Vickers, plus there'll be a man from Barclays, a man from JP Morgan, a man from the FT, and a woman who used to regulate the gas industry. Bank regulation under Labour was not a happy story. Pensioners at Equitable Life lost billions. Tony Blair publicly attacked the FSA for regulating too aggressively. Banks like Northern Rock and B&B were allowed to expand mortgage lending so aggressively that they crashed. Then came the collapse of HBOS and RBS, dragging Lloyds to the brink and forcing the government to nationalise them in all but name. This graph illustrates the problem they're trying to prevent. The curve shows the amount UK banks were borrowing relative to their capital. When the FSA was formed in 1997, Britain's banks were clustered around a borrowing ratio of 20-1. After 2000, they began to take bigger risks, and then, between 2005 and the global meltdown, the risk-taking massively increased. Macroprudential regulation means stopping banks taking risks that could crash the system. It means raising interest rates to take the steam out of a housing bubble. It means leaning against market forces to smooth the economic cycle. And the problem is not that the wrong people did it, but that it was never done. Some of those who've seen the failures of the old regime are sceptical about the new one. Paul Moore's revelations about regulatory failures at HBOS led to the resignation of the FSA's vice chairman last year.
You still go back to the same point, which is you need very strong quality, high calibre people of a different nature to run the regulators so that the banks simply cannot run rings around them. There's so much vested interest and revolving door between banks and the Treasury and regulators. We simply have too much conflict of interest in the policy thinking and in the supervision and regulation of these banks.
It's just 3 years since Gordon Brown told bankers at the Mansion House they were in a golden age. Tonight's speech was made amid the wreckage of that age, but few of those present could, hand on heart, claim the danger is past. Beyond these marble halls, unemployment is still rising. The banks can still feel the tremors from Greece and Spain. And there's a mountain of bad debt still to get off the table.
Paul Mason, well, just before we came on air, I talked to the Business Secretary, Vince Cable, who for the past few months has also been part of a commission inquiring into how to break up the banks. I began by asking him what the Chancellor meant when he said the Financial Services Authority will no longer exist in its current form.
Well, what the Chancellor is saying is that the system of prudential regulation, in other words, dealing with issues of risk to the system, will be brought under the management of the Bank of England, the Governor of the Bank of England. And there are other activities that the FSA does, particularly to do with consumer protection, which will be dealt with separately.
The Chancellor also talked of ending confusion, providing clarity, uncertainty has to be dispelled. And yet, as I understand it, you're concentrating bank regulation, as you say, within the Bank of England. You're setting up a new independent financial policy committee, a new consumer protection and markets authority, plus the FSA will continue to exist in a different form. We've gone from a tripartite system to a many-headed system.
I don't think that's right or fair. I think the most important single change, which is what produces clarity out of what was confusion, is that the Bank of England is responsible for systemic risk problems, issues of prudential supervision. Prevention of the collapse of the banking system, is what we're talking about, is firmly the responsibility of the Bank of England.
Right. Well, obviously, where is your position in this then? Because, you know, we're very pleased to talk to you about this, but it did seem when you were appointed Business Secretary, you would have some direct role in this. Then it was made clear you don't. And now, as I say, we're very glad to talk to you. But what is your role in this?
Well, my role in this is I was working jointly with the Chancellor in drawing up this new commission, which is looking at the structure of banking. We've jointly identified the members of that commission, and I have a role working with the Chancellor. He leads on financial services and banking, but I work with him on the broader issues surrounding banking, and I have a particular responsibility in respect to bank lending. There's long been overlaps of responsibility between the department that I head and the Treasury, but we're working together very effectively and collaboratively.
But effectively and collaboratively, but you have sat for months on your own Commission on the Future of Banking. You've just produced a report which talks about the breakup of banks. Now we're to have another commission on this. No wonder people are confused.
Well, they're totally different animals, and their origins was quite different. The commission you refer to, I was involved as our Shadow Chancellor in opposition. I worked with John McFall, David Davis. That was an opposition exercise. It produced a report which I didn't see any more of once I'd taken up my office in the government. This new commission is a set up by the Chancellor and myself to come to a final conclusion about what we do about the structure of banks. There are very widely divergent views, some of which were expressed in that report that you refer to. Other people have very different views. Regardless of ideology, this is a controversy that cuts across parties and ideology. We need to come to a conclusion on it.
That's true, but for instance, one of the members of the new Commission, Martin Wolf, says the proposals to break up the banks, which you've been advocating, are unworkable, undesirable and irrelevant. It sounds like this new commission is being set up to come to a different answer from the one that you've already come to.
Well, I've read Martin Wolf's articles, and the starting point of his own argument is that there is a big structural problem with the banking system, and that is, of course, part of the terms of reference. And the people that we have appointed come from different positions in how you deal with it. And the whole concept of breaking up the banks, as you put it, is a complex one, and it can be done in different ways.
But would you be happy if the Commission comes to a different conclusion, completely different conclusion to the one that you've already come to?
We're going to interact with them. They're going to report back to the Chancellor and myself on as part of the governmental process. We're referring the matter to them. These are highly expert people, very high-quality people. And we hope they'll come to a consensus and later rest an argument that has raged for now quite a long time since the banking crisis emerged. I don't want to prejudge the conclusion.
Would it be binding on you in any way?
No, the Commission's report will be referred back to the government, and the government will decide what it does with it.
You want to increase lending to businesses and others. So does the Chancellor. So is one way of doing that for you to say we should put, as a government, our own people on the boards of banks in which there is a big public stake?
Well, there are already, of course, in the case of the Royal Bank of Scotland and Lloyds, there are already representatives indirectly of the government, and the government it influences the way they behave. No, the Chancellor and I are currently working on this whole issue about how we do better than the last government in getting banks lending to small, medium-sized companies. This is the key bottleneck.
But could you do that by putting people directly on the boards with a mandate, effectively, from the government to tell them to lend more?
I think there are different ways of doing it, and we're currently exploring the best ways of doing it.
Mr. Cable, thank you very much.
Thank you.